Guys, today this is the first time I have a venture-backed, capital-backed CEO of a so-called Amazon aggregator. Okay, Pierre Poignant, okay, is actually the co-founder and CEO of a massive conglomeration of aggregators. Okay, and you've probably seen it in the news, which is between Heyday, all right, and Branded. Okay, two big aggregators came together, and Pierre is leading them. This is a highly monumental moment because we're going to get inside scoops into how in the world is this aggregator model working. Is all the news you hear on in the news and the media, the crashing, burning, all that stuff, how much of that is true? What's happening internally? And we're going to get the inside scoop today. Pierre, thank you so much for coming onto the show.
Thank you, Aaron. Very nice to talk to you, to meet you, and to be here. I work with at Essor. We have two founders, Bo and Victor, and they speak very, very highly of you. I think you've been working with them in the past, building brands from Florida. So very happy to be here in the show.
Awesome, absolutely. So yeah, that's a good way to just talk about it. So Essor, right, which Branded acquired Heyday and created Essor, right? Branded purchased Victor and Bo's company back in the day. That was a Viking Revolution, and they had some other brands around there as well. And so you guys have been buying, people who are very good brands. I think you guys have been made very good choices in which brands you've been buying. I don't know how public some of these are, but I know three or four companies you guys have bought. They're all fantastic companies with good brands behind them. They're not just like, hey, I sell, a yoga ball and there's no branding behind it with a random name. I've seen that it's a lot of good brands. And I want to get into how you guys chose in getting which kind of brands and how you do that process. But before we get into that, I want to talk about your story. What led you into e-commerce? What is your background that you have the qualifications to come into this position where you're dealing with hundreds of millions of dollars, actually billions, at least $1 billion, I guess, between both of them, Heyday and not, or something.
No, a bit less. We'll get to that. A little bit less. 400 million.
400 million. Okay. So you're no, but I'm talking about investment, right? Didn't Heyday raise how much did?
Yes. Shy of a billion. Yes, I think it depends on how you count it. We'll get to that also.
Okay. So we're talking about somewhere near $1 billion of investment. What brings Pierre Poignant to the table to say, hey, you're going to be the one leading and being in charge of almost $1 billion of investment funds? Like, why you?
So I think we have to start a little bit way back, Aaron. I hope you don't mind.
Please.
If I interrupt me if you want to be more snappy, but I'm French. I think you can hear that. And I finished my studies in the US. Actually, I went to the US in 2001, in September 2001. So that was quite an emotional time to come to the US and to discover this amazing country. And I was at MIT. I'm a graduate from MIT. I've got a master's of science over there. And I happened to meet my wife at MIT. And my wife is Singaporean. So I will start with that. And in 2001, you're probably a little bit younger than me, Aaron, but this was the boom day of eBay. And I was in Asia, starting from 2001. I spent lots of time in Asia. I was in Singapore, and I saw lots of, the e-commerce arbitrage. So I was buying mobile phones in Singapore from Indian traders out of, and I was bringing those in suitcases back in France and selling them in eBay in 2002, 2003. And
eBay was a French eBay, or you're telling it US eBay?
French eBay. I was doing it in the French eBay, yeah. And it stopped when eBay starting to collect VAT, so all the sellers, So anyway, so fast forward, and then I spent time at McKinsey. 2012, I was in Singapore. We moved to Singapore. We have two lovely kids, that were born in Singapore. Beautiful. Also because that's the way to be. 2012, I was there, and e-commerce started to grow in the region. Very small at the beginning. So But this was the year of where Southeast Asia, it's an amazing part of the world, Singapore, Indonesia, Malaysia, Philippines, Thailand, Vietnam. The region was developing, internet was coming in, mobile phone was coming in, social media was coming in, and digital services, digital e-commerce came in. And with a bunch of other folks, we co-founded a company called Lazada.
And, Lazada, that's right. That's a massive. Okay, so sorry, continue. So you were part of co-founding Lazada.
Correct. I was the CEO of Lazada.
Wow.
So this thing, amazing company. We grew the business from pretty much zero to several billion. I think when I left, it was around 15 billion of GMV.
Mm-hmm.
And we sold it in 2017 to Alibaba. So at that time, so this is how I really developed the love for e-commerce. And
so hold on. Wait, I feel like we could spend the entire podcast on just that story, and we could get so much. That is unbelievable. So hold on. I want to dive into it a bit more. So Lazada, right? That's essentially the Amazon of that area, right?
Correct. Yes.
And when you were starting that, okay, were there other ones already existing, or was it literally like we're the first?
No, so that's the point. So, talk about right time, right moment, and right value proposition. This is a very example. This region was relatively poor in 2012 or 2010, coming out of the Asian crisis and then the global financial crisis, But then, very young region, and this was developing. And when a region develops, it means that suddenly disposable income, when you get a little bit more money than what you need to live, it's massive in terms of disposable income per month. So a lot of people had suddenly money to spend. And there's no shopping mall. There was no shopping mall around many of these places. At the same time, they were basically a lot of the Chinese firms were deploying 4G. So Huawei deployed 4G everywhere with the different cheap Chinese smartphone like Xiaomi, Poco that came in, and Facebook came in also. So every single Southeast Asian had, a bit of money, had a cheap Chinese smartphone, a 4G connection, and no shopping mall where to go. So it all took off. This region, and many great companies took off at the same time. It's not only Lazada. There was like company like Tokopedia was e-commerce, Traveloka, Shopee was also an e-commerce, Grab, all of these companies took off and really grew at a super fast pace, and that's what happened essentially.
Wow.
And we came in with there's a lot of e-commerce players that try to gain this market. We came in, I think, with the right value proposition. We had it's built around trust. We were the trusted platform. People discover e-commerce. They want to get into trust. And we're also very aggressive. You know how you need to be in e-commerce. Aggressive on the offer. Aggressive to gain market share. Aggressive against competition. Aggressive marketing.
So what does that mean, aggressive? You're doing humongous deals, losing a bunch of money. Like, what do you mean aggressive? Can you define that a little bit?
So you have to be, I think, Aaron, you're running an amazing brand on Amazon. You are constantly faced with competition. You're constantly faced with Chinese sellers trying to eat your lunch. And you're aggressive because you run deal, because you have a better product for the customer. You constantly ask yourself, how do I improve the experience for my customer? Mm-hmm. E-commerce, is very simple. E-commerce is good product at a good price. Yep. That's e-commerce, and you drive it on digital channels. And I think you have to be aggressive on this. And that's what we mean. Yes, of course, we build market share, so we lost a bunch of money. But fundamentally, we were more reactive to what the customer wants, more reactive to what competition is doing. And that's how we got there.
That's amazing. So then in Lazada, how much can you share? Like, how much of that equity did you have? Like, Pierre, hey, I have this much of this company.
So this I'll keep for myself, but we got diluted pretty much, but I did very well for myself, Aaron. So at that time, it was amazing. Of course, you have financial reward, but I think it's a very rewarding journey also. So all the people I met, what we built, the culture we built, I think that's that's the intangible rewards that makes this so memorable.
Right. And how many were the co-founders? How big of a group was that?
So we were a bit more than 10 people. Okay. I think we had a core group, so the CEO was a person called Maximilian Bittner. He is now leading Vestiaire Collective, if you know this company, an amazing e-commerce business out of Paris also. And then we had a couple of colleagues in each country. So that's how we were running the business.
That's amazing. And then did you fundraise? Did you fundraise for that whole thing? I'm assuming that wasn't bootstrapped, right? Like how?
No, yeah. So we raised a lot of capital. We had famous players we had Tesco that came in. We had finally Temasek in 2014. So 2 years in, Temasek invested $400 million in the business. It's all public. And then in 2016 and then 17, Alibaba bought the whole company.
And how much was that? How much was that exit? That's public, right?
3 billion. The valuation of the company was 3 billion at the time.
Wow. So that's a 3 billion. That is a humongous sum of money. But more importantly, that is the amount of value you brought to that entire region. This is hundreds of millions of people. What would you say is the population served by Lazada? Like the people living using the software?
At that time, when I was there, we would have, so it's 600 million people, and within a year, we would have around 100 million different customers. So in 2020, 100 million people, different people bought on Lazada.
Wow. So almost 20% of the population using literally a site that you guys made, which is absolutely unbelievable. Okay. So 400 million to 3 billion, that's not bad. Okay. So then going forward from there, go ahead.
Yeah, back to your question. Actually, I mean that's. Then I joined. Also, I was for 2 years. Afterwards, I became the CEO of the company. I was at the XCOM of Alibaba when we got acquired.
What is XCOM? I don't know what that is.
Yeah, basically the team, the business team, okay. the leadership team, the leaders of all the different business units. Of Alibaba. That report to the CEO. So we were meeting in Hangzhou every month.
Hold on. So you're saying, okay, you had this Lazada unit, and then you were managing a bigger part of the company, not just the Lazada, right? No.
I mean, as part of Lazada, I was part of one of the big business unit at that time of Alibaba. And I think back to your question, what led to Essor and branded? I think I saw in Asia how entrepreneurs have built amazing brands on marketplace. Yep. And it's not super common in at least 4 or 5 years ago. I think now it's different that people would think about going to Amazon, going to digital channel to build a brand. Mm-hmm. A lot of people think about, hey, I need to go offline first, or I need to have my own Shopify. I need to invest tons in marketing. Mm-hmm. A path where you build great product, you have product market fit centered on product, and then you build the brand from Amazon. I think there's not so many on this. How do you do brand building on the marketplace? So when we saw this opportunity of, there was capital to raise to, aggregate promising brand, promising sellers to create a group, I thought this is amazing.
And when you say we, who is we now?
So me and my co-founders. So we had I have currently at that time in 2021, Ben Kaminski. He was in a fund called Target Global, mm-hmm. who was already looking at this opportunity. I partnered with him, and then another co-founder called Alexi and Michael, and we got together to do this. And the idea was really to basically acquire, we saw a lot of teams that going in one direction, mm-hmm. And build their company. You want to compete, you have to go in the other direction, So we said, all right, we are going to focus on larger brands. I'm not going to buy a lot of small things. Mm-hmm. Not to say we did our fair share of mistakes, but we're going to, like everyone.
Sure.
So we're going to buy larger businesses that have already a moat. Maybe the growth potential is not like bam, mm-hmm. Maybe I'm not going to times 2, times 3 or I cannot think about times 2, times 3, but these businesses have a moat. They have already like customers. They have proven something. And also they so focused a lot on businesses that have some sort of like brand or starting of a brand, brand searches on Amazon, have a range. It's not only a hero SKUs, it's a bit broader than that. And then also the second choice we made is that we are going to partner with the founders.
Yes.
For 1 year, 2 years, 3 years, 4 years, whatever the time frame. Because a brand, I mean, I've seen that over and over again. When you create a brand, it relies on the founder. The founder is the soul of the brand. They have like the knowledge of what makes the difference. Is it, product market fit? Is a certain marketing angle? It is a certain customer set. And this knowledge is often intangible and reside in the founders. And we understood that. And we said, all right, we need to partner with these colleagues. And that's what we did. So some of them since then left, some of them stay with us, that's life. And I think that's a bit how we got to this opportunity a bit differently.
Yeah, because a lot of your contemporaries, meaning the other aggregators who started around the same time, a lot of them fell and were done. They just went like to zero. There's been several that have liquidated all their portfolio, some that have gone to bankruptcy. There's been a lot of failures. And would you say that what you just said is one of the things that made you guys not fail, which is working with those brand owners?
Correct. I think, and you also know that very well, Aaron. And marketplace is a bloodbath. It's a day-to-day fight, and that's the beauty of it, by the way. Because once you are successful on marketplace, your product is unbeatable. So we shouldn't be afraid of that competition. That's what makes us, improve the product for the customer.
Yeah, okay. I mean, I don't know. I think everybody needs to be scared every moment because the guys will come after you, right? If you don't move, what I tell people is if your product is the same, 5 years from now than you have today, you will be gone, right? Okay. You're dead. You cannot have the same product mix. You do need to be afraid of what's coming. But if you are afraid, meaning maybe not afraid, but if you prepare for it, then you can defend properly. If you're defending by getting better product, then you have an easy way of it because you have the advantage of reviews, understanding the market, the keywords, etc. So, I mean, I agree with you to that degree that it's easier.
The second part also, to operate on the marketplace, you need to be a bit sneaky, You need to understand because very sneaky people are going to come at you.
That's true.
So you have to not be, of course, you have to operate within the bounds of the realm of the platform. Otherwise, long term, it's going to come back to you and it's going to hurt you. But you also need to understand what others are going to do to you. And I think we really treasure the colleagues that were from sellers before, from brand, who kept them in the team. Most of, if I look at the brand manager that we have today in the company, a lot of them come from the sellers, and that mix of brand building experience, e-commerce experience, seller experience. I think that's the mix that it's the people, basically the team that you have that makes the success, I think.
Right. If
you come at it with, at this topic where you just hire colleagues that, from consulting and from
your MIT background. All your guys who you were with at MIT, right?
I mean, Aaron, all of this is good. You need to have a mixed team. The team with only same people is bound to fail.
Okay.
You need to have a mixed team.
That's a good point.
I think that's what we've tried to do.
So hold on. So what's the mix between sellers and people in the e-commerce space versus the MIT type Ivy League more kind of thing? What's the mix there? You have to have a mix. What kind of mix are you looking at?
I've not quantified it lately, Aaron, so I can't tell you basically. But I think probably like maybe 30% of the colleagues were from sellers before, so maybe something like that, 30%. I have not counted for a while. And a lot of them have been with us for quite a while, so they are completely. It's all part of the same team today. But the important is that we got quite diverse team around the table to build our brands, and I think that's the strength.
Yeah, and then that's beautiful.
I think the strength. That's the strength. That's what I'm trying to convey.
No, beautiful. I love that. And so, how many of the brands that you've acquired you kept some sort of partnership status with the seller? Was it, what percentage? In that case, is it nearly all of them or how much?
I think it would be maybe 40%. 40%. So we acquired also small brands. Honestly, some of the small brands we acquired we were not successful. We acquired the small brands with unique products, and then or products that we acquired products in categories that we didn't know so well or not familiar, and then it just didn't work.
Yep.
So we have a fair share of it, but all the major deals we did were in partnership, and the brands that are today are strategic brands basically. So. I think that's what we've done there.
Okay, no, excellent. Okay, good. So you said all of the bigger ones. So the smaller ones, then 60% would be the smaller ones, because 40% you partnered with, and you partner on the big ones. Is that, am I getting there somewhat?
At the beginning, that time we were very focused on, hey, we have to make acquisitions. So we had our strategy, but we also need to make acquisition. So we made some mistakes. I think that's what it is. So. Fortunately, the mistakes were small in the size of revenue.
Yes.
So most 80%, 85% of our core revenues today, or at least branded, were big acquisition we made that were successful.
That's awesome.
And then we made some mistakes here and there.
That's amazing. Okay, and then how did it occur? So this, the merger, or it was more of an acquisition than a merger, from the way I read the press release. But how did it occur? Hey, we're gonna acquire Heyday. Like, how did that process start and then culminate?
Yeah, so I think the Heyday, we've spoken to many different teams across this whole ecosystem, and Heyday has gone with a actually pretty similar strategy as branded at that time, and they've acquired very good brands. If you look at some of the brands they have, like Boca, Fresh Cap, Num Num, Iron Flask, these are fairly tree of life, very, very strong brands, are in similar categories as us, because I believe in category synergies. So health and wellness, basically, and lifestyle kind of brands. And so it's a very complementary fit in terms of portfolio, both nature, brand focused, nature of the categories. Then they have capabilities that, they're very strong in some capabilities where we are not at branded. We are not very strong. So they have very strong retail capabilities, brand building capabilities. I think we just came up with like a Zitstica. I don't know if you saw that. We're doing a partnership on Zitstica with John Boy, tattoo artist, and these kind of things are created. It's good for brand building, and they've done a lot of things like this. And then they also invested quite a fair bit in technology. And I think that to run this business, a strong data platform is critical. Absolutely. And I think we will benefit. So we've been discussing with a lot of people, and Heyday is was really a very, very good fit with the two teams. So and I think in our acquisition, because it's there's a majority, like one of the shareholders that are bigger pie, if you want, but from all matters and purposes, this is a merger. The way we work as a team and so on, it's a merger in all ways and purposes.
Okay, and so then they had cash flow. Okay, because the main thing that people, like the aggregators, so to speak, as a group, the cash flow is the killer, right? I know I've spoken to a few, close, and what killed a lot of these companies were the interest rates going crazy. At least that's what they say, right? I mean, when your debt payment goes from, I don't know, let's say $400,000 a month to $900,000 a month, as a theory, because of interest rate changes, that could have been your entire free cash flow, and now you're negative. Now you can't keep up with the payments, and then you default on the loan. So. Yes. Is that story, right? Like, let's just dive into that. How do you see the cash flows, right? In branded, right? You acquired, you got debt. There's cash flow stuff. Like, how did you manage that? And then I have a follow-up question, I guess.
Yeah, so I think I'll talk about maybe the combined entity or Essor.
But it will be before, right? Because I don't like. Heyday has its own kind of cash flow. Branded had its own cash flow. Now there's one, but like there's a story before, no?
Yeah. So I think before we were a bit more than $200 million revenue, and to call it 220, close to double-digit EBITDA. And I think we would cover our debt with our we were covering our debt with our current cash flow. That's where we were. Our lender was is still BlackRock. You know
BlackRock. BlackRock,
so
huge.
So I think one thing we did is that we didn't deploy too much debt. We acquired with a fair amount of equity also. So that's the debt load was one of the lowest in the industry on branded. Same on Essor, and by the way, same on Heyday. So as we combine, and Heyday is in many ways was a bit similar, without entering details. As we combine.
So just pause for a second. So, okay, so Branded, what you're saying basically is that even with did you guys have fixed interest rates or variable interest rates?
Fixed.
Oh, that saved your ass hardcore. I mean, so that was a smart decision.
Yes.
Wow. Okay, so you were able to cover the interest rate. They didn't change. Your debt stayed fixed. And so the money that you guys made after paying everything was able to cover the debt. So basically, in terms of cash flow, Branded was at least break even or positive as Branded as an entity.
Correct. Break even. Let's call it
break even.
Correct. Break even. So, now the question is, that's I think an important point, because I could have said, hey, I continue myself, you know? And by the way, same for Heyday. I continue myself, because when you continue yourself, you have less dilution for shareholders because it's so. But I think today we're a moment in time where there's going to be a lot of opportunities in the market. That's what we believe. So interest rate going down, a lot of brands. I mean, the market has been dried up in terms of liquidity in the past 2 years, 3 years. It's very hard to sell your brand at a decent multiple of the past 3 years. Basically, it's dried up, And I think both capital is coming back with the interest rates coming down. There's going to be more capital in the market, in retail, in commerce. And brands want to sell, or portfolio of brands want to sell. So there's a moment in time where in the next 18 months, 24 months, we need to capture that moment in time. And therefore, putting the two companies together, not only I'm break even in cash flow, but I even have firepower that I can use to acquire.
Because you're saying because the investment, right? The investment in the merger, there's a lot of equity that went up.
There's more cash flow because I've got synergies. I've got the debt that came together, and all of this that gives me firepower. So of course, we first need to make sure our business works as a standalone. It takes a bit of time to put the two teams together and the two platforms together. So that's what we're focusing on. But essentially, that's the story, Aaron.
And when you say firepower, what do you mean exactly in firepower? Firepower, which direction are you, getting ready for?
For acquisition or growth. So basically, if you have a business that just generates very little cash flow, then it's very hard for you to grow, because you can grow organically. Some businesses are very successful at that. But if you want to reinvest in marketing, or if you want to invest in acquisition, it's very hard for you to do. If you're able to generate cash flow, you can usually either use that cash flow to acquire. That's one, or you can leverage that cash flow, get more debt in order to do the acquisitions, because you have cash flow. So that gives us flexibility for the future, and that's what we want to do, and that's also linked to the timing.
That's great. So now, when you approach, I know very, very little about venture capitalists and these kinds of equity and these kind of stakes, these BlackRocks and these kind of big companies and how they operate. So could you just give me a general idea of hey, Thrasio, the valuation went from a ridiculously high, it dropped quite a bit, right? They had a huge dilution of what the investment was. So wouldn't like these big ventures say, hey, this money is not working out how we thought it was, and they would be quite skeptical, to go to bat again and go for more investments in this space.
Yeah, no, totally. So that's why you see very little new investment coming in. So you see very little new fund, new capital coming in. So the money we raised is from our existing shareholders that know how we work, understand the business. So that's why you see a lot of internal rounds for our business, but for also many businesses in e-commerce across the industry. It's not only related to Amazon, so-called Amazon aggregator or brand builders. It's true for many businesses in this industry, in the digital world, basically. Post-COVID, what has happened is that during COVID, liquidity was plentiful because of the stimulus. So Bitcoin prices went up. Amazon seller prices went up. Everything went up, and valuation went up. The idea, the thought was that people are going to shift completely their purchasing pattern, their consumption pattern. They are using the convenience of in-store, so they're going to order more food online. They're going to consume more services online. They're going to buy e-commerce online, and that was the idea. That was, it was amazing. People suddenly start to work differently, start to go to the gym remotely on their Peloton, and then if you see that and you see that shift so brutal and adopted by consumers.
It was also forced. If you close the stores, hey, but I see where you're. I know that was the big pitch. Yeah.
So it's not. It's then you get excited and you say, all right, this is going to be the new normal. So and then suddenly everyone wakes up because interest rates have to go up. Because inflation is out of control. Interest rates go up. When interest rates go up, it's mechanical. The future cash flow value it decreases. So then the second thing is people realize that, hey, I still like to go to the store. I still like to do this and that. I still like to meet people. And then the future cash flow goes down. The value of the future cash flow goes down. So there's been a very big shift in valuation, and you can see that across the board. Stronger businesses have done better because they are more diversified, and they're also more monopolistic, in the US in particular, and they've done better. But you see that has affected everywhere. So it affected our business, and it has dried up capital essentially. That's what happened. That's why the valuation of Thrasio was an amazing business, and Carlos. I know Carlos. We were from the same department at MIT, So we were both. So I was not at the same time as him, but we were alumni from the same. Fantastic business, fantastic idea, Made some mistake like everyone, but I think the valuation expectation and the debt put on the business didn't match so the expectation on financial profile didn't match what they were able to deliver, and that's where the situation. But if you look at some of the brands they have, the operations they've done, it's amazing.
Were you shocked to see when they got the new investment? I think it was $60 million or somewhere around that, like a new investment from the guys that just lost so much money. Was that surprising to you?
Well, I think it's a bit. I think asset inside has still a value. There's very good brands. I'm sure you know some of them, Angry Orange and Nippy. So they have very good brands in there. So there's value, and I think they have a new team, and so the investors want to make sure they preserve the value and build on that. So I think that does make sense. I don't know the terms, but I would understand a rational way.
Makes sense. Okay. And now when you mentioned hey, brands are having a hard time getting a decent valuation for exit, what kind of valuation do you think, maybe should be normal? What is that? What valuation are people expecting?
No, so I think I think it's a tough question, Aaron, because what goes into valuation has a lot of different components. I think especially what people often, especially when you go down in terms of size, valuations are far more variable. One of the reasons, by the way, is because the founder works 80
and they have
hours
zero
a week,
salary, right?
and he doesn't. And they have zero salary. So you may end up with a perceived low EBITDA business, but if you were to add the same caliber of person into the business and pay him a salary to deliver the same value, then the EBITDA would have shrunk a lot. So it's valuation is very difficult. I think you have to look at the business today and also the potential in the future. And I think the more willing is the brand owner to take a risk on the future, so then the higher essentially the payout will be. That's essentially how you get it. I think you can look at a comparable, CPG company of smaller size. They trade at anything between 7x to 15x corporate EBITDA. Now the question is, do you have a full cash upfront, and how do you compute the EBITDA?
And you're talking about EBITDA. I don't know what the other one is. The same EBITDA, right? Is what you're saying? Like the earnings, yeah, okay.
EBITDA,
and that's what you're saying when they're publicly traded. CPG companies publicly traded 7 to 12, 7 to 15 times EBITDA is what it trades at. I mean, that's true. That's what you're saying. No, that's a PE ratio, kind of, right?
Yeah, but you look at Procter & Gamble, Church & Dwight, and Church & Dwight probably trades at 20. Procter & Gamble, I don't know, if 17. And then if you look at other brands, I mean, you can look at the comparable how they trade in terms of EBITDA. So that's public market. But these are for very big companies. When you have smaller company, there's for sure more risk, unless there's high potential in the business. And then you have to look at how do you compute EBITDA. The EBITDA of a publicly traded company is far stricter than the EBITDA of a small company. It's a gap versus adjusted
sure.
EBITDA,
You put it on a napkin. So when you're acquiring, okay, you're planning to still acquire like portions and keep the founders on going forward with Essor.
Correct. That's what we would do. Yes, correct.
Okay, and so in that case, yeah, go ahead.
No, I think it's very important for the reason I mentioned earlier. The founders are the soul of the brand. They embody the brand, and I think it's very, especially for the smaller brands. So when the business is smaller or younger brand, I think it's actually very, I would say, dangerous in a way to cut the founder immediately. So I think then it becomes a personal story. What does the person want to do? Some people may say, I want to stay a year and a half only, because I have other projects in my life. Some want to stay 2 years, 3 years, 4 years because they have fun with it, So then it becomes a personal choice, and then I don't have a recipe for that. Every deal has to be a bit different because it's two groups, people that get together essentially.
Okay, and so on a valuation on cash, you guys don't do any cash. You're not planning to do cashes, but on valuation in the market, what have you seen on a all cash deal? How they're going right now, trading today?
All cash deal, I've seen very little business. I've seen very little businesses getting all cash. I think all cash deal, we're talking about 2-3x EBITDA.
Yeah, I think that's.
No, that's what all cash is. That kind of level.
I agree. That's where it is, and so in that case, this is the kind of multiple you're saying. Like, hey, people a lot of times they don't think it's worth it to exit, because right now, or I mean, sometimes maybe.
Well, I think why would you exit a business? It's different. It's personal as a question, and it's different based on there's no uniform answer. 2-3 years means that it's basically 3 years of cash flow that you get in one time. So if you were sitting operating your business, you would get that within 3 years, maybe a bit less because you would grow. So that's essentially what it is. So then the question is, maybe you've done this for 6, 7, 8 years, and you're a bit bored of it, whatever, and you want to go something else. Maybe there's a life event. Maybe you want to de-risk. So many businesses went up and then down after, and then you think you want to de-risk. You have other ideas. You have several businesses in your portfolio. I think many different reasons why would you sell your business.
Yep.
I think.
I agree. And I mean, the truth is too, when you're growing the company, the retained earnings is pretty high. Like you have to keep the money in the company. So if you grow your sales, you plus taxes, when you sell, you're going to get a capital gains tax. When you operate it, you're going to get normal tax. That makes a humongous difference in the cash. So it's more than, it would be more than 3 years if you take the tax into consideration, you take inventory into consideration. But at the same time, fine, of course, in theory, it's 3 years. But I don't know. I think I do see things exiting in that range. And in your case, and how much you want to get into it is up to you. But when you do these partnership deals, you take a strong brand. Of course, you're not going to give them a 3x if you want them to stay on and do the thing. You have these earnouts and these structures. Is there any sort of amount you could share on how you structure that? Like, say someone's listening, like, oh my gosh, I want to sell to Essor. Like, what is the way that you would, go about that?
Also, I can't enter obviously like numbers because that's of course our whole strategy in a way, Aaron. But typically we would take a controlling stake, so we need to have the majority. So for sure, and we need to decide essentially, and we need to integrate the business. So that's the base of it. Then afterwards, I think we would typically want to work with the founders for at least 2 years, And then in the case of Essor, I think we'll probably look at exiting the business in the next 3 years, through IPO or through whatever, different exit that we have. I think that will be in the mind of our shareholders. You build the business for long term, but, shareholders may want to see returns, So, and in that case, we may have discussions with founder, hey, let's do this together, So, then the timing becomes a little bit more uncertain, but I think that's also the fun of it.
Yeah, and when you entered like unbranded, did you have a similar idea? Like, hey, let's make branded and exit in 3 years. Was that the idea as well?
I think so. You look back at 2020, 2021. The boom day of the SPACs and all of that stuff, the crazy IPO. So. For sure, we had that in the back, like these thoughts cross our mind. I would say, Aaron, for sure. At the same time, I know for experience, it's not the first time I build a business. So you cannot focus on the exit. If you build a business for exit, you're going to fail. So from the get-go, we were, of course, you can prepare a business for exit. And sometimes it's good for the business to prepare a business for exit, And I'm sure I've seen some of your posts. You advise sellers on this, So I think it's good to prepare a business for exit, but don't build a business for exit in a way. And otherwise, the culture of the, what about the culture of the team? What about the long-term differentiation? What about the moat that you create? You're going to be very focused on short term, and that's not good at all for the business. Really not good. It's not what's going to lead to a good outcome.
What has been the most fun thing for you being in this Amazon buying of companies and operating them space?
For me, I think the most fun process that I have in the company, in a way, is product development. And because, we have this product development. So every product that we launch, last year we launched, I think, 300-400 products. Like there's variation of course, in this number. Next year with the combined business, we're probably going to launch 600-700 products. So we have this product committee, and colleagues come and they explain why this product. I'm sure you do the same with your team. Then they say, hey, this product, I love this. This is what I love, and it's the most fun. Discovering new niche, discovering new markets. That's the fun. So it's also the same when you buy. You come, you meet a founder. They've created these products. You talk to the founder. You try to understand why. Why is it different? What makes it such a good product for the customer? That's the fun part. That part,
That's amazing. I love that. I see you look happy talking about it. So I feel the same way. I told my team if I could do like product development all day, I'd be happy. If I could, but I can't really. You know what I mean? Like,
yes.
Okay. So. Why, I get asked this question myself because, as you may or may not know, but we actually acquire brands as well. We acquire brands within Zulai. Yep.
Yeah, I've seen that.
Yep. We also acquire as
yes,
Nexus Capital, right? And we do private investments, right? So accredited investors invest private, and we don't raise debt for that. But people ask me all the time, okay? And so I'm going to ask you, because I know this is something is interesting. If you guys know, you have sellers who know how to launch products and grow from zero, why be so interested in buying a company when you could just launch the products yourself?
Yeah, so I think, so first of all, what we do is building brands. So one aspect of it is expanding the product portfolio. So we are more interested in the brand, not only, collection of product. So that's from our perspective. Second, I think we launch a lot of products. There's two things. When you have an existing brand or an existing business, it's easier to expand. So you're in one category. You're in the lemon juicer thing. Then you can go in the garlic press thing. There's going to be similarities. You're in the milk frother, and then you go to the coffee business. There's things better, and you have your moat in your product. Your moat means you have reviews, you have a position, you have ranks, you have a high quality product that you have tailored bit by bit to the customer, step by step, and then you have better COGS because you're big, so you have negotiated with your supplier in wherever is the supplier. So starting from there, you expand. And I think that's much easier. And building that moat is actually very hard. It's not so easy to launch product from scratch in new niche, be successful and dominate the niche. It's not so straightforward. So we like to buy both these two things. We like to buy brands that are platform brands that I can acquire the brand and launch product within the brand. And I like to acquire brands that have a few hero products, that dominate in certain niche. So that we do launch products. So if we launch products, we do it within our brands often, and then we 100%. Expand from there.
Sometimes you launch outside of a brand ever? What, you launch in a new brand or no?
We've done a few times. Yes, we've done a few times new brands. We've also gone into new niches, And so you do this from time to time, but I think you have to do it in yourself and acquiring. I think it's you deploy capital to acquire. You get to much faster, and then the next capital to launch will be actually much less riskier. And from a human resource perspective, is also you need to have quite a lot of people to achieve the same outcome. So I think you have to do both, and that's the recipe for success.
Awesome. And so, and I agree with what you said, by the way. Like launching with a brand is way easier. If Nike releases anything in footwear, it will do way better than Joe launching the same thing, right? Period. Like you have the name, that's going to happen. So I agree with that. Now, would you consider, let's say, so you guys own Viking Revolution, right? Which you got from Bo and Victor. And that's like the beard. You have a lot of beard stuff and men's grooming. Now, in there, you could launch any product in men's grooming. Okay, you already have that launch pad with the brand. Would you consider buying a competitor to that? Where in that case, you have a brand, you could launch the competitor's products in the men's grooming already. So would there be a reason for you to want to acquire in the same space that you're in?
Yeah, totally. Yeah, totally. And I think the reason would be that because maybe price points are different, and maybe the angle for the brand is different. Maybe it caters to a different demographics, and then you have synergy. Totally. And I think you have the knowledge, so it's very good. I think the best is if you buy a second brand, it should be managed by the same people. So then they manage both, So and then they make the trade-off, and you do this with the person that manages, and then they manage both brands. At least leadership.
You get cost savings
and
there.
Then I think very, very valuable. Then it becomes very valuable. You can share, sometimes product development ideas are shared, and then you tweak one for the other. So it's highly, highly valuable to have brands that operate in the same space, and then you get them to manage by the same person, and then you the same group at least, and then you coordinate, and then you have a lot of value.
Nice, brilliant. Okay, good. So I have some questions from audience over here. How risky do you think it is to have an Amazon-only brand?
So I think it's a very. So I think there's different way to look at this. So I don't think Amazon will just be. I mean, I think Amazon is a very reliable channel for the long term. It's a long-term reliable channel. So they. You hear things. They take rash.
I don't think so at all.
I don't think so.
I agree with you.
Amazon is a rational player, long-term view, and I think the GMV on Amazon is like $1 trillion now in the US, or close to $1 trillion. 800 billion. So the way you have to think about it, it's like an economy. It's like the Amazon economy. You come here, and then there's, it's massive. So I think that it's going to evolve. So I think that's the best digital place to operate. Now, if you have only €1 product in one niche on Amazon, I think that's not so good, because you are at the mercy of people that come copy you, especially if if you have a product which is fairly copyable, especially by China, then no mistake, you're successful. 1 year later, you're gonna have 10 people coming in doing the same thing as you. So that's not so good. So I think if you have a brand and you operate on Amazon, I think you can really stay on Amazon. There's you can create a lot of value. You're focused on one channel. You diversified. Fantastic. Now I think if you want to create extra value, I think it's good to go into multiple channels. So I think it's good to have a fairly decent direct consumer site, so that you can engage with your audience, engage with your customers. For example, we see that a lot of our customers, they buy a Piracy product, it's one of our brands, or then they come back, they go to the Piracy.com and they buy bigger bundles and they repurchase, and we see that, we have we see that because we tell them, hey, where do you come from? And then they say, hey, I discovered this on Amazon, and now I'm coming to the Shopify. So that's good. And I think it's also good to be on retail, on the shelves, if you're able to do this, because that leads to far more brand equity building, because people will see. Typically, the pattern is that they will see you on the shelf, they will know the brand, and they will look for it online, sometimes look for it on Amazon. So, good example, we have recently one of our brands called Iron Flask has launched on Walmart and Target. Okay. We've suddenly seen a spike in brand search on Amazon. And we don't do anything different, it's just because it's on Walmart and Target shelf. Come and look for it, So that, I think that creates a lot of value to do this. So I think it's a multi-pronged answer, Aaron, on this. It's not a direct, it depends on the situation and so on, but clearly being multi-channel has a lot of value. We also see that international has a lot of value. So all our brands, we bring them UK, the whole of Europe. Typically, European marketplace are less competitive, there's less review, and you can really dominate some niches, bringing your product. Once there's a barrier to entry, of course, logistics, customs, packaging, and whatnot. So this is, you have a barrier to entry, but once you've gone over this, I think it's highly valuable.
I agree. Okay. Funny, the next question is almost kind of similar, but it says, as an aggregator, how do you minimize the inherent risk that comes with Amazon? Which, I mean, you kind of answered, but maybe you have some more.
Yeah, I think so. We spoke about it earlier, but I think on Amazon, and that's the beauty, it's on all digital marketplace, you need to always be have the best product, the best price. So I think focusing on having the best product, the best price, I think that's how you win on this marketplace, on these digital shelves. And I think you focus your energy on this, be ranked well. With a good product at a good price, and then that's the recipe for winning. And then, of course, you diversify niches or channels.
I had a Jabron Niaz on the podcast earlier, and he's a bootstrapped Pakistan. He's like he's the number one brand on Amazon. He does 700 million on a bootstrap the brand every year, which is crazy. And I'll tell you, he has the same concept of what you, Jack, said. A great product at the best price. How do you lose, right? So I just want to reiterate, like, I mean,
Yeah.
yeah, absolutely. I agree with that. Okay, so how about this one? What is Essor going to do differently than, you know, the guys that have failed? Like I know Thrasio hasn't failed because they just framed funded. They're re-going, but like the guys that did go into full on entire failure that are disbanded, you know, you're seeing that. What are you doing to, you know, avoid against that and come out on the top?
Yeah, so I think we focused, I think I mentioned it a little bit, but we focused on different strategy from the get-go. So we had larger brands, and both Heyday and Branded, by the way, constituting Essor, larger brands, high awareness brands, home, like coherent set of categories. And we didn't do that many acquisitions. I mean, we didn't go and do so many acquisitions. So focus on sustainable growth. So, and I think that's really what led us. We also were very prudent on capital deployment, so level of debts and so on. So I think that's what made us come on top. I think the guys that have, you know, bought a lot of different things, and you have an aggregator. I mean, I have a top 10 brands or 12 brands. They are public, you know, and that's 80% of our business. So that's who we are, you know. So and that's we communicate a lot, or I try to communicate a lot about our brands, you know, and that's who we are, and that's what we want to put forward, you know. So we're not a collection of small products. We have a 10, 12, 13 brands that are, you know, really driving the business, and that's what we bought, and we will be successful because of our brands. So have a look at our brands and think about, you know, are they good or not? Are they promising? You know, would you invest in them individually? And hope the answer is yes, and that's what will make us successful.
All right, so Pierre, what is, in the end, for a brand, right? You've seen so much activity in the space, things that fail, things that go. What makes a brand be able to succeed and continue on into the future that people should focus on when building?
I think that's very tough, because the answer is quite different for all the brands, you know. So you need to have built, you need to have a level of differentiation that's very important, and stand for something, you know, so that you have to create an affinity with your products and your brands from the customer. So how you do this is there's a lot of different ways to do this. Often it's linked to an experience that the seller or the brand builder has. It's quite personal a lot of the time. So they want to change. They want to create a new product to the world because they believe it's gonna change, or they have an experience and they want to share it. So I think that's what a lot of brands that I've seen successful have been built like this. So if I give an example, it's Puracy was one of our brand was built because the founder at that time is a chemist, you know, long, like 8 or 10 years ago, and his wife was pregnant, and they were cleaning the house, and the dog licked the floor, and the dog fell sick. And because, you know, of the shit that's inside the chemicals, you know, the cleaners. And then he was like, okay, what's in there? And then he started to look at the formula. I was like, oh, yeah, indeed. So we have created a brand which is natural plant-based ingredients, so that it's a brand that you can ingest. So you can don't do this, Aaron, but it's as good as it's like, it's not harmful, nor for the skin nor for the body, you know. And that's the way the brand was built. So it's a very personal thing. If you look at one of our other brands called Fresh Cap, it's a mushroom brand. It's a mushroom supplement brand. The founder is Canadian. He has a love for mushroom. He has a show. You can go on YouTube. It's called the Fresh Cap Mushroom Show, and he talks about mushrooms. You know, and that's how he created the brand. You know, that's another brand is called Ototo. You know, they are kitchen. I hope you look at what we do, Aaron. I think we are in several niches together, Aaron. So, and it's a brand that these are two product designers, and they created the brand 20 years ago, Ori and Danny from Tel Aviv, and they want to bring a spark of joy to everyone in the product in the kitchen. Kitchen products can be functional, but also can be fun. So that's what that's the mantra. And they've created these beautiful products for the past 20 years, and the brand exploded on TikTok and on Amazon 4 years ago. So this is when we acquired the brand, partner with Danny and Ori. They're still with us. They still design products, and we're growing this brand all across the US. It's going to be in Target in December, end cap in all the 2,000 plus Target stores. You can buy Ototo product in December. We are everywhere on TikTok. We are everywhere in different small specialty stores across the country. So it's great. And what the designer do, they keep, Ari and Danny, they help us on shaping the brand future, design new products, and so on. So it starts from the founders, and I think that's very
awesome,
very good,
amazing.
important.
Okay, last question: do you put a combination? So building Lazada in that Southeast Asia market, are you taking your brands over to that area? I mean, you know the sales over there.
Yeah, so I think the market is very different in Southeast Asia. So it is a market that is very the economics are different, prices are different, margins are also different than in the US. So typically, if you look at if you are in the we are in the the knife category. So we have knife blocks, and you go and you look at the kind of knife sets that there is on Lazada and there is on Amazon. It's very different. Price point, but also quality. So our brands would be premium on there. So I think it's not conducive. Once we have very strong brands, we can bring into this marketplace. So Ototo, for example, we're in discussion, and we have another brand called Num Num. So if you have kids, Aaron, I hope you used it. It's spoons to help feeding. It's a Num Num. It's a patented products. We are the number one spoon for babies on Amazon. So we have the bestseller, and have a look. And we're going to distribute this brand into Singapore. There's a big distributor that reached out to us, actually say, hey, I want to distribute that brand in Singapore. And he's going to sell it in Singapore Lazada, for example. So yes, once you have a great brand, you can go.
Nice, brilliant.
So we're getting there. We're getting there with some of our brands.
Amazing. Well, Pierre, you've shared a lot of knowledge, a lot of things that you've been doing and are going to do with Essor, the great brand building, how to launch products, and I really appreciate your time. Are there any parting words about Amazon, about the space, about anything you want to share with the audience?
No, thank you very much for having me in the podcast, Aaron. I love to talk about what we do. It's a pleasure, and I think Amazon is a great place to start a brand and be an entrepreneur. So I would encourage hopefully the audience to jump into the bandwagon.
Well, guys, Pierre Poignant, CEO, co-founder of Essor. Thank you, guys.